Well, thank you very much for having me in Madrid. Thanks to Gestion and the Valuespain community for having me all the way from Singapore. I'm quite humbled to be amongst this, elite crowd here. I must say, coming from Asia, the one thing that strikes me about Spain is the value investing community in Spain, which is quite amazing. Back in Asia, we have a lot to learn from Valuespain, so congratulations to all of you. Thank you very much for the invite. So just before we begin, I'd like to just talk about Amiral Gestion. The firm was founded in about 2002. We manage about 4 billion euros. Our track record in our main fund is about 16% CAGR. We like to fish globally in inefficient markets. We have offices in Paris, Madrid, and Singapore. My colleagues here, Pablo and Francisco in the crowd in our Madrid office. And so my focus throughout my career over the last 10, 15 years has been in the Asian inefficient markets. I get excited by meeting companies, the first top three shareholders in small cap companies that we meet. It reminds me of sort of developed markets back 10, 15 years ago. So Asia much reminds me of that. Today I'd like to present an investment idea which is sort of far away in the Asian equity markets. A company that I believe offers a heads you win, tails you don't lose much type of scenario. Plus it offers the opportunity for predictable earnings growth, which is so it has a combination of what I like, which is both asset value as well as predictable earnings growth. This is in a country where I'm from, which is India. Nesco is the name of the company. India, as you know, actually Ray Dalio, is very bullish on India. Moinish Pabra, a very notable investor, has quite a few Indian equity investments. I believe, I present an idea which you should look at. For those that don't have access to India, please feel free to write to me. I'm happy to connect you with the right people. So today we discussed Nesco. The company has a $610 million market cap. But the price asset here is that the company has this hidden asset value. The company has a 70-acre parcel of land in prime Mumbai CBD. Bombay, as you know, is the financial capital of India, 25 million people, 70 acres of land, which was bought at cost at $1 million in the 1950s. The family bought the parcel of land for $1 million 60 years ago. This is worth 80 to 100% of the market cap. The company is not just a boring asset play. It has cash on its books, which is about 80 million. 80 million cash on its books. What if I could also, besides this asset, tell you that this company has grown revenues 21% CAGR over the last 10 years. The company has an EBIT margin, 10 years median, of 68%. The company has a net profit margin of 59% in the past 10 years. When you look at some of the best businesses in the world, which have pricing power, customer stickiness, economies of scale, you would still be hard-pressed to find a business with financial metrics like this that offer downside protection because of the land value. So insiders own about 68% of the company. They eat their own cooking. They're very rational value investors. I met the chairman about December. I took a site visit of Nesco just a few months ago. And the best thing is that they're very, very long-term. Very long-term. The company has never had debt over the last 10 years, or very negligible. So just to summarize, it has both asset value as well as predictable earnings growth, and we'll talk more about this. So why is Nesco worth your attention? Nesco is worth your attention because of the hidden asset. It provides high barriers to entry, which are not replicable. The three key reasons are location, location, location. The second reason is low-cost structure, because the land was bought 60 years ago at $1 million on the balance sheet. So you won't find it unless you actually did your channel checks, you went to India, you understood that the land was still booked at cost at $1 million. This is worth today, in today's comps, it's worth at least $600 million. Think about 70 acres, 40 football fields. So this provides huge barriers to entry. As you know, Charlie Munger says, always look for businesses with durable competitive advantages. I believe that Nesco has a durable competitive advantage, which is quite strong, and which I believe will last for the next 5, 10, 15 years. And if I'm wrong, you can't lose much money because the asset value provides downside protection and the company doesn't have debt on its balance sheet. So they bought this 70-acre land in the 1950s. It's located very conveniently right next to the Western Express Highway. So this part of Bombay, 10 years from now, 15 years from now, is almost guaranteed to be much more valuable than it is today. And you have to see it to believe it. I was there, and we'll show you pictures of the site visit. The land parcel gives Nesco some very high margins, as discussed. In addition to the asset value, so I tend not to just be stuck sort of in asset companies that have asset value. There's lots of those in Asia, but this company actually offers you predictable earnings growth because of catalysts that have already taken place, because the government in Bombay has enacted some regulations where they've changed the floor space index in Bombay from FSI 1 to FSI 3 and 4. And so there's a huge 15-year runway for growth for this company. By the way, it's reasonably liquid. It's more liquid than some of the ideas that have been presented earlier. So just to summarize, the company has 3 main businesses. The first one is the IT park business. The IT park is really just, the company has this simple, boring business, buildings that they rent out to blue chip customers. There's rent increases each year. It's a 3-year payback period. I learned one thing growing up: you want your money back in 3 years. That's a good business, and this business has it. It's just IT park business. The best part is there's 3 more buildings coming up over the next 5 to 10 years that provides lots of growth. This business has EBIT margins of 85 to 90% because of the land. The second business is India's largest private exhibition business. So if you want to hold a large-scale exhibition in India, you have to go to Nesco. So they've got the blue chip foreign clients. When they come to India, they have to hold the exhibition. This is where they have to hold it. It's 2.5 times bigger than the next competitor. This is going from FSI 1 to FSI 4. So currently it utilizes about 13 acres of land. In the next 10 years, it's going to, the land is going to be optimized, used more optimally to FSI is to 100 acres of land. So there's 7x the growth opportunity. And this is in a business that management already knows for the last 15 years. The other businesses are food and events. So they serve, it's like selling popcorn in a movie theater. They serve food and they conduct events, large-scale events in this piece of land. Management, I believe, are very long-term owners, and they have this vision to build a Nesco hub. This is just the background and the timeline of the company. The company was a very boring industrial goods business back in the day. That's why it was called Nesco. The full name, Nesco, stood for a very boring company. And with investments, you want something simple and boring and predictable. So there has been, that's the son here. He's a very astute value investor. They both studied in the US. And so it's transformed from this boring commodity business, which was an industrial goods business, to a realty plus a private exhibition business, which now has significant growth because of the FSI rule changes. So there are 4 key reasons why the stock is mispriced. Amiral, just a disclaimer, we've owned the stock for 3 years. It's already been a 3-4 bagger, but this is a punching card for the next 10 years if you want to have exposure in India. There are 4 key reasons to buy this stock. The first one is the IT parks business is a cash cow. It's a simple, predictable business. There are 3 more buildings coming up, 85% EBIT margins, 3-year payback, simple. Second is the Bombay Exhibition Center is India's largest private exhibition center. It's 2.5 times the next competitor. So there's significant location and cost advantages. The third is valuation. Heads I win, tails I don't lose much. If I'm wrong, the margin of safety is very high. There might be mark-to-market fluctuations, but the risk of permanent loss of capital is very small. Of course, crazy things can happen, and but the track record of management suggests that they're very rational capital allocators. And the fourth is that they're very conservative, value-oriented management. Their bonuses are linked to net profit, so they get a cut of the net profit, and so they're highly incentivized. I first presented the idea about 3 years ago at Manual of Ideas. Amiral's owned it since. It's been a three-bagger, but it's a punching card for the next 10 years because of the catalysts that have already happened with the FSI. So we are not waiting for catalysts to happen. The catalysts have already happened. So the first business here, this is a site visit. This just shows you IT Park 3, which has 85–90% EBIT margins. The building on the bottom is IT Park 4, which is going to hit in December 2018, and this is going to start generating revenue in 2 or 3 in 2 years with 85–90% EBIT margins. It's doubled the acres from the previous 3 buildings. It's right opposite this under construction, the metro, so it's really in a good location. This is just a summary of the IT parks, what investors should know. I mean, you have the slides, so you can go through this. If you have any questions, you can write to me. Essentially, if you see here, you see FSI 1 and 2.5 for the previous buildings. That's going to be 3 in the next for the upcoming buildings. And so it's really a business they already know. It's just about execution. The payback period for the worst building is 3 years. The EBIT margins are 80–90%. And it's highly free cash flow generative. This is just a map. There's 2 versions of the map. There's the old map and the new map. This just shows on the 70-acre land like where the IT park business is going to be. I won't go through in a great amount of detail, but the key point here is that because of FSI 3, the increase in the number of acres is going to be 5x over the next 10 years. So it provides you this hidden asset, downside protection, with upside because of predictable earnings growth. The second business is the Bombay exhibition business. This is India's largest private exhibition business and has a long runway for growth given FSI 4. Previously it was FSI 1. And so it's going from 13 acres or so to about 100 acres. So it's about 7x more over the next 10 years. Food events provide additional upside. These are just some pictures from my site visit in Bombay in December of various exhibitions. I'm from India, but it certainly truly impressed me. The site visit is a must if you want to understand the Nesco story. It attracts about 1 million visitors annually, more than any other venue in Bombay. It has held about 1,000 exhibitions since inception. Just some numbers here. It's 2.5 times the size of the next competitor in Bombay. Has 80% EBIT margins. This is the old map, and this is the new map. So they're actually redeveloping the old exhibition because of FSI 1. If you go to Bombay, you'll see these. It's not like Shanghai where the FSI is much higher. So this story is about one where land is going to be used much more optimally. So this is the old map. It's just flat kind of exhibition centers, FSI 1. It's going to FSI 4 in 4 phases for the next 10 to 15 years. Through internal free cash flow, so management's very averse to taking debt. They've had very little debt if you look at the balance sheet for the last 15 years. And so this plan is going to be executed over the next 10, 15 years. It's a business that they already know. The new businesses are the Nesco Food and Events. So they host some of the biggest events in Bombay. Armin van Buren was there in December, so they host some of the biggest events. Very high margin. And the foods, it's just like selling popcorn in a movie theater. The last is just the valuation. So what I like about the company, and I've repeated myself several times here, but it's hidden asset. If I'm wrong, the downside protection is there because of this land parcel, 70 acres, which is what the market cap plus the cash pile, which I believe is going to rise. But also the visible earnings growth. There are very few companies that I could find that have an EBIT margin of 50%, even if you look at the best businesses in the world. So the valuation is a sum of the parts. It's not art, it's not a science, it's an art, and you can apply the multiples that you want, but it's very simple. So you have the IT Parks business, the 3-year payback. I've applied a 12 times EBIT multiple to this business. Frankly, if you go to India, you'll see businesses trading at 20, 25 times at much worse economics. So I've been fairly conservative, 11, 12 times on some of the parts for its IT Park 3 and IT Park 4, and then a 10 times multiple, 8 to 10 times multiple for its Bombay exhibition business. I believe this business is not as great as the other business, so I apply a lower multiple. Again, if you go to India, you'll see businesses trading at 20, 25 times, so I'm being very conservative here. The industrials business, I've not applied. I've given it 0 valuation. Cash, I believe as IT Park 4 hits this year, this cash pile is 78 currently. This should rise. So that number might be quite conservative. And then the land value, it's debatable if you add it in the SOTP, but anyways, the point here is that even without the land, at current market cap, you're well compensated for just the operating businesses. And by the way, what's not reflected in this SOTP is the yellow part, which is the redevelopment of IT Park 1, 2, then there's 5 and 6, and then there's Bombay Exhibition Center in 4 phases. This is just as of 2021. I believe net profits would double in the next 4 years. I look for companies that at least can double EBIT or net profit in 4 years, otherwise it's not interesting in Asia. And so if you looked at the PE multiple, it would just be about 10 times, if you doubled your net profit, which I believe is quite conservative. And so the point here is that heads you in, tails I don't lose much. The last section is the management. They're incentivized, highly incentivized management. I had a call with the father. He's about 80 years old now. I had a call with him 4 years ago. And he was surprised. He asked me, why are you calling me? Because, there's no foreign investors calling him. Even today, Nesco is not very well known in India, which is quite crazy because the Sensex is hitting all-time highs, but it's not very well known in the Indian community. Only 2 or 3 brokers cover it, even after the stock has gone up 3-4x. The son is, I hope he takes over faster because he's, in my view, shrewder than his father. His name is Krishna Patel. He's 38 years old. I met him in December, and a very astute value investor. His bonuses are linked to profitability in the company. Well-known value investors own this stock. Besides Sextant, besides Amiral, you have Catamaran Advisors, which is the family office of Narayan Murthy. You have some of the other well-known value investors that own this stock. It was actually recommended also by a well-known guy called Sanjay Bakshi, who some of you might know. So that concludes my presentation. It's a boring idea. It's a small cap idea. You may not have access to India, but I recommend you take a look at it. Low downside, but significant upside over the next 5-10 years.
Thank you very much, Sid. Anybody has questions? Hi. How much of the, thanks for the presentation, by the way, how much of the land value is excess land value? How much is a use of for the
Very good question. 80% is not used because 80%. The FSI 1, if you go to Bombay, you'll see these, not very high rise. So this FSI 1 just uses 20% of the land. When it's redeveloped, 80% of the land is not used. Currently, it's about 60-70%.
Yeah, currently it's 60 to 70% is still free.
Free, yeah.
Yeah, okay.
Yeah, so there's huge runway for growth.
Yeah, but in your valuation, you include the full value of the land.
So you know, 5 years from now, that's going to be worth $1 billion. So it's, you know, you could, that's what valuations are not a science. You know, you can assign what number you want to it. We can take it out of the valuation. You're still going to make money. But the point is that at current precedent valuations in India, a 70-acre land sells for about $700–800 million. So I've only said 400 million, 500 million, being quite conservative. I think in Madrid, a 70-acre piece of land would be worth a lot of money, right? Central Madrid.
I've seen such situations in our region, and there was always a reason why the company never sold the real estate. So what's the history here? How come they never actually sold?
Well, I'm glad they didn't sell, because they're sitting on a... sell the real estate, you mean?
Historically, I'm sure developers came to them to try and buy these plots. Were they distracted? This was non-core and it became core? What's the history? How come they ended up after decades owning such a huge property?
They know this is you're sitting on a pot of gold. I mean, this is Bombay. So if I'm very happy they don't sell. It would be crazy to sell, because you have this huge barrier to entry. I mean, guys like Reliance and, you know, whoever else with lots of money and trying to buy land, it costs a lot of money. So yes, they do get lots of offers and proposals, and a catalyst in the future could be some sort of REIT in the future. So there's lots of options available, you know, that could happen. When I saw this company 4 years ago, it was a boring, just 2 buildings, the exhibition of 1. So with this land, you have, the best part is that there's upside surprise, because and India is only a 2 trillion GDP. China is 10 trillion right now, and so it's one of the fastest growing countries. Ray Dalio loves it. So inflation, you know, this is a hedge to inflation as well.
Is there a risk that there's going to be a lot more floor space coming to market if these planning permission rules apply to everyone? So maybe their runway to growth applies to the market as a whole, so in 5 years' time you're going to have huge supply. Is that a risk?
Yeah, there's always risk, but you know, the demand-supply situation is such that it's just skewed in its favor. There's only one. This is 2.5 times the size of the next one, which is Reliance, which is 2.5 times smaller. There's just enough room for everyone. But here there's only 2 or 3 players. You know, if you want to have a large-scale exhibition in India, you have to go to Nesco. The location is very close to the airport. They're also building a 4-star hotel, which is, you know, and management, by the way, is very conservative. If you talk to them, they will always downplay the numbers because they don't like talking to analysts. So, you know, initially when I contacted them, it was a bit of a struggle, but, you know, the more I've got to know them, you know, it's quite attractive.
Thank you very much for your presentation. I would like to know if you have an idea of the value of the company, of the market to market, of the land plus the buildings at the moment.
At the moment?
Yeah.
The value of, well, the value of the land is at least $600–700 million right now.
And what are the buildings?
It's a 85% net margin, no, EBIT margin business that generates about, I don't have the numbers in front of me, but that, you know, put what multiple you want. I would at least put a 15 times multiple. This is India, you know, lots of businesses trading at 20, 25 times. So given the predictability, it's almost certain that EBIT is going to be up 4x. So I would say 15 times current EBIT. You know, I would say the value of the company is at least $1 billion right now. But I could be off.
Okay, thank you.
We can take offline discussion if you want to discuss the...
Okay. Thank you very much then.
Okay.
Thank you.